Welcome back to the deep dive. For many years, UAE Freezone basically meant tax-free. Simple as that. Today, we're diving into probably the biggest shift there. The latest corporate tax updates. These really changed the game for how Freezone companies keep that valuable 0% rate.
Yeah, the days of it being automatic are definitely over.
So the era of just setting up shop and assuming zero tax, gone.
Exactly. And our goal today is really to give you the shortcut on Ministerial Decisions 229 and 230. They came out late last year, but crucially, they applied back to tax periods starting from June 2023.
Right, the retroactive part.
Yes, it's all about defining who is a qualifying free zone person, or QFZP. That 0% rate isn't a given anymore. It's earned based on showing real economic activity and, importantly, compliant pricing.
Okay, let's break that down. Starting with the activities that's Ministerial Decision 229.
Yeah.
Historically, commodity trading was, generally fine, but often needed the raw stuff. What's the big expansion there?
Well, the commodity piece is huge.
Yeah.
MB 229 actually gets rid of that old raw form idea. So now dealing in processed metals, industrial chemicals, energy, certain agricultural goods that can all qualify for 0%.
And you mentioned something quite interesting there.
Yes. What's really, I think, forward-looking is the explicit inclusion of environmental commodities. Think carbon credits.
Carbon credits. Okay, that's definitely signaling support for green finance within the zones. And for all these commodities, new and old, the critical bit is they must have a quoted price.
Absolutely critical, because that quoted price, it acts as an objective benchmark, something verifiable. It takes away the risk of the tax authority saying your pricing is just made up, forces transparency right up front.
Makes sense. And MD 229 also gave a bit of a boost to international holding groups operating here, didn't it?
It did. It confirmed that treasury and financing services for related parties, or even just for the free zone entity's own needs, are clearly qualifying activities. That's strategically huge for multinationals using the UAE as a finance hub. Simplifies things.
Okay, now this is the bit every free zone CEO needs to nail down. The de minimis threshold, the safety net.
Right. So if you have a small amount of revenue that doesn't qualify maybe some minor local sales, for example, you might still keep your 0% QFCP status.
Mike, what's the catch?
The catch is that non-qualifying revenue can't be more than 5% of your total revenue, or AED 5 million, whichever number is lower.
The lower of the two.
Precisely. If you go over that limit, you risk losing the 0% rate on all your income for that period. It's a hard line.
Ouch. Okay, so documentation is key. Which leads us neatly to the other decision, Ministerial Decision 230.
Exactly. If 229 tells you what activities qualify, 230 is about how you prove your pricing is fair market value. This decision actually names the official price reporting agencies, the PRAs, that you must use for commodity transactions.
So no more ambiguity. You use these specific agencies for pricing.
Correct. It aligns everything with global transfer pricing standards instantly. The message is clear. The old brass plate company, just a name on a door, that's officially done.
And this ties into the broader transfer pricing rules too, right? Master file, local file.
Absolutely. If you hit the revenue thresholds, you're subject to the full UAE transfer pricing regulations. That means maintaining potentially hefty documentation like the master file and local file. It's serious compliance.
It really shows the UAE integrating with those global OECD standards on substance and transparency. It's not just about oil revenue anymore.
It supports that diversification push, especially into finance, sustainability. It's all part of that bigger picture.
Now, while the tax rules got stricter, there was also an operational change trying to make life easier. The One Free Zone Passport Initiative.
Yeah.
That was July 2025.
Yes, that's right. A potentially very helpful initiative. It means a company licensed in one participating Dubai Free Zone can operate in other participating zones using that same single license.
Sounds great. Less paperwork.
It simplifies licensing, yes, but, and this is a big but, you have to know the limitations straight away.
What are they?
It excludes certain sectors, think retail, regulated financial services, DNFBPs. And crucially, this passport does not let you transfer your staff to the second zone or use virtual offices or flexi desks there.
So it helps with the license hurdle, but not the actual economic substance requirement in the other zone. You still need boots on the ground, essentially.
Pretty much. It's about the license, not the physical presence or substance.
Got it. So let's pull this all together for you, the listener. To keep that 0% rate, what are the absolute must-haves now?
Okay, 3 core pillars. 1, Audited financial statements, MD 84 made that mandatory.
Pillar 2.
Demonstrable economic substance. That means a real local office, actual employees doing the work there.
Fan 3.
Rigorous documentation and pricing following these new rules in MD 229 and 230, especially around qualifying activities and using those PRAs if needed.
Okay, clear. Pillars, audits, substance, documentation.
And one quick practical tip, if you happen to be late registering for corporate tax and got that initial AED 10,000 fine, there's a potential waiver. You can get that fine removed if you submit your first CT return within 7 months after your first tax period ends. It's an incentive for timely compliance going forward.
Good to know. Okay, let's wrap up with a thought to chew on. The UAE is clearly working hard to align with global tax norms. We see it with these free zone rules, and especially with the upcoming 15% domestic minimum top-up tax for large multinationals starting Jan 2025.
Pillar 2 implementation.
Exactly. So if the UAE, which really pioneered the modern free zone concept, is now adopting global minimum tax principles, what does that signal for the future of special tax incentives anywhere in the world? Can countries really afford to offer unique low-tax deals for much longer in this environment? Something to think about as you plan your global strategy. We'll see you on the next deep dive.